Thank you for the opportunity. I will explain about receivable. Receivable often referred to as loans and receivables are claims held against customers and others for money, goods, or service. A customer often owes a company amounts for goods, book, or service rendered. A company may subclassify these trade receivables, usually the most significant item in its current asset, into accounts receivable and notes receivables. Accounts receivable are oral promise of the purchaser to pay for goods or service sold. They represent open accounts resulting from short-term extension of credit. A company normally collects them within 30 to 60 days. Notes receivable are written promise to pay a certain sum of money on a specific future date. They may arise from sales, financing, or their transactions. Notes may be short-term or long-term. Non-trade receivables arise from a variety of transactions. Non-trade receivables are 1. Advance to officers and employees, 2. Advance to subsidiaries, 3. Deposit paid to cover potential damage or loss, 4. Deposit paid as a guarantee of performance or payment, 5. Dividends and interest receivable, 6. Claims again, like insurance companies for casualties sustained, dividends under suit, governmental bodies for tax refund, common carriers for GMAC or lost goods, creditor for return GMAC or lost goods, customer for returnable items, crate, container, etc.
I will explain about recognition of account receivable. Account receivable generally arises as part of a revenue arrangement. For example, if Lululemon sells a yoga outfit to Jennifer for $100 on account, when does Lululemon recognize revenue, the sales, and the related account receivable? Revenue recognition principle indicates that Lululemon should recognize revenue when it satisfies its performance obligation by transferring the good or service to the customer. It follows that in the Lululemon situation, the yoga outfit is transferred when Jennifer obtains control of this outfit. Lululemon makes the following entry, assuming that $100 is the amount it expects to receive from Jennifer. Account receivable $100 at debit and sales revenue $100 at credit. Next, measurement of the transaction price. The transaction price is the amount of consideration that a company expects to receive from a customer in exchange for transferring goods or service. In the Lululemon case, the transaction price is easily determined because Jennifer agrees to pay a fixed amount to Lululemon over a short period of time. However, in other situations, companies must consider items such as variable consideration which may affect the account's receivable balance. Next, the variable consideration. In some cases, the price of a good or service is dependent on future events. These future events often include such items as discount, return and allowance, rebates, and performance bonus. Here are 4 items that affect the transaction price and thus the account receivable balance. The first is trade discount. Price might be subject to a trade or quantity discount. Companies use such trade discount to avoid frequent changes in catalogs, to alter price for different quantities purchased, or to hide the true invoice price from competitor. Trade discounts are commonly quoted in percentage. The second is cash discount or sales discount. Companies offer cash discount or sales discount to induce prompt payment. Cash discount are generally presented in terms such as 2% if paid within 10 days, gross amount due in 30 days, or 2% if paid anytime by the 10th day of the following month, with full payment due by the 30th of the following month. The third is sales return and allowance. Another form of variable consideration relates to sales return and allowance. The fourth is time value of money. Another variable consideration issue relates to the time value of money. Ideally, a company should measure receivable in terms of their present value, that is, the discount value of the cash to be received in the future. When expected cash receipt requires a waiting period, the receivable face amount is not worth the amount that the company ultimately receives.
Valuation of account receivable. As one referred a content applied note, the credit manager's idea of heaven probably would be a place where everyone eventually paid his or her debts. Unfortunately, this situation often does not occur. Companies record credit loss as debit to bad debt expense or uncollectible accounts expense. Such losses are a normal and necessary risk of doing business on a credit basis. Two methods are used in accounting for uncollectible accounts. One, the direct write-off method, and two, the allowance method.
Here I will explain about note receivable and valuation of note receivable. Note receivable. A note receivable is supported by a formal promissory note, a written promise to pay a certain sum of money at a specific future date. Such as note is a negotiable instrument that a maker seeks in favor of a decided pay who may legally and readily sell or otherwise transfer the note to others. Although all notes contain an interest element because of the time value of money, companies classify them as interest-bearing or non-interest-bearing. Interest-bearing notes have a started rate of interest. Zero interest-bearing notes or non-interest-bearing include interest as part of their face amount. Notes receivable are considered fairly liquid, even if long-term, because companies may easily convert them to cash. Companies frequently accept notes receivable from customers who need to extend the payment period of an outstanding receivable, or they require notes from high-risk or new customers. In addition, companies often use notes in loans to employees and subsidiaries, and in the sales of property, plant, and equipment. In some industries, notes support all credit sales. The majority of notes, however, origin from lending transaction. The basic issue is in accounting for notes receivable are the same as those for account receivable. Recognition, valuation, and recognition. Valuation of notes receivable. Like account receivable, companies record and report certain notes receivable at their cash value, that is, at their face amount less all necessary allowance. The primary notes receivable allowance account is allowance for the full accounts. The computation and estimation involved in valuing certain notes receivable and in recording bad debt expense and the related allowance exactly parallel that for trade account receivable. Companies estimate the amounts of uncollectible by an analysis of the receivable. As discussed earlier, receivable with a significant financing component, such as a long-term notes, involve addition estimate problem.
Other issue related to receivable. Additional issue related to receivable are 1. The recognition of receivable. 2. Presentation and analysis. The recognition of receivable. At what point should a receivable no longer be included as an asset of a company that is recognized? One situation occurs when the receivable no longer has any value. That is, the contractual rights to the cash flow of the receivable no longer exist. For example, if Unilever has a receivable from a customer who declares a bankruptcy, the value of this receivable has expired. Similarly, when Unilever collects a receivable when due, it removes the receivable from its books. In both cases, Unilever no longer has any contractual rights to this receivable. As a result, the receivable are derecognized.
I will explain about presentation and analysis of receivable. The first is presentation of receivable. The general rules in classifying receivable are 1. Segregate and report the carrying amount of the different categories of receivable. The number 2, indicate the receivable classified as current and non-current in the statement of financial position. Number 3, appropriately offset the valuation account for receivable that are impaired, including a discussion of individual and collectively determined impairment. Number 4, disclose the fair value of receivable in such a way that permits it to be compared with its carrying amount. Number 5, disclose information to assess the credit risk inherent in the receivable by providing information on 1. Receivable that are neither past due nor impaired. 2. The carrying amount of receivable that would otherwise be past due or impaired whose terms have been renegotiated. Number 3, for receivables that are either past due or impaired, disclose an analysis of the age of the receivable that are past due as of the end of the reporting period. Next, number 6, Disclose any receivable flagged as control. Number 7, disclose a significant concentration of credit risk arising from receivable.
Thank you for the opportunity. I will explain about analysis of receivables, accounts receivable turnover. Analysts frequently compute financial ratios to evaluate the liquidity of a company's account receivable. To assess the liquidity of the receivables, they use the accounts receivable turnover. This ratio measures the number of times on average a company collects receivables during a period. The ratio is computed by dividing net sales by average net receivable outstanding during the year. Theoretically, the numerator should include only net credit sales, but this information is frequently unifiable. However, if the relative amounts of credit and cash sales remain fairly constant, the trend indicated by the ratio will still be valid. Barring significant seasonal factor, average receivables outstanding can be computed from the beginning and ending balance of net trade receivables. Thank you.